So thanks for the invitation, and this is a wonderful event to be part of. Because time is short, I'm going to dive straight in to my topic, which is automated high-frequency trading. As the name suggests, involves huge amounts of trading, typically small trades, but huge volumes in total. Makes up most of the trading in the world nowadays. Very little trading happens in the traditional trading floors. Critically, and this is going to be the important part of the talk, it involves prediction of short-term price movements, and short-term here means a second or less. And it takes place in data centers such as that, packed with thousands and thousands of computers. There are 6 data centers in the United States where it happens, as you'll see in the map. 2 of them are in Greater Chicago, 4 of them are in northern New Jersey. Nearly all the trading in the United States takes place in those 6 data centers. Giant warehouses packed with thousands of computers. There's one such data center, one such building in Germany. Anybody know what it is? It's a building called FR2, FR2. It's near the Kruppstrasse U-Bahn station in Frankfurt, and virtually all the trading in Germany happens in that one building. So I'm drawing on a study that I'm doing. I'll not go through the detail, except to mention, because it's going to come back later, one particular firm, possibly the world's oldest high-frequency trading firm, called Automated Trading Desk. I'm doing a historical study of that, plus all the other stuff that's on the slide. And I've been interpreting it through what I like to call material sociology. That's to say, an approach that gives equal weight to the material world and to the social world, and indeed doesn't really attempt to distinguish between the two. I mentioned in the first slide, I mentioned predicting short-term price movements as critical to high-frequency trading. And it's in a sense kind of puzzling that algorithms are able to do that, because prices jiggle around, and financial economists teach that the jiggling around is a random walk, is not predictable. Yet prediction is possible. High-frequency trading algorithms do it. So that suggests that there is, as it were, structure within the randomness. And the basic thesis that I'm putting to you is that that structure, the thing that makes prediction of price changes possible, that's, as it were, the congealed outcome of struggle. So there's not just economics, so to speak, built into it. There's also politics built into it, even in a certain sense, culture built into it. And the particular structure that I want to talk about is called futures lag. And essentially the rest of this talk, which I'm trying to give quickly because of the time, the rest of this talk is a little history of this thing called futures lag. It's a Chicago story. Up until 1972, Chicago was the place where you traded futures on agricultural commodities, above all, futures on grain. But the traders in Chicago, they're always on the lookout for new stuff to trade, And one thing they would have really liked to trade is futures on stock indexes, such as the Dow Jones Index or the Standard & Poor's 500 index, because they knew there would be a big market if they could trade such futures. But there was a barrier to be overcome, a legal and ultimately a moral boundary. If you traded grain, then ultimately you could settle a futures contract in grain by one trader's railroad cars rolling up to another silo and unloading the grain. You could intend to deliver, even if in practice you very seldom did deliver. The problem with a stock index is that an index is a mathematical abstraction. So it's at best clumsy to work out how you could physically deliver on a stock index contract. And if you couldn't physically deliver, then that, in the law of Illinois, also, of course, in the law of Germany, made it a wager. It made it a bet. And in Illinois, that was actually against the law. So the congealed struggle here, or the struggle that has subsequently become congealed, was to circumvent that moral and legal barrier. Two people key to it: Leo Melamed, chair of the Chicago Mercantile Exchange, and Philip McBride Johnston, the lawyer of the great rival, the Chicago Board of Trade. There's a lot of detail here that I won't go into, but it involved the creation of a new federal regulatory body, the creation of a very deliberately broad definition of what it was that this regulator was going to regulate. And because it was a federal law, and in federal law in the United States there is no ban on gambling, it circumvented the moral, legal boundary. There was a little historical trace here that I suspect at the time nobody really paid any attention to. The new federal regulatory body, the Commodity Futures Trading Commission, because of the historic roots of the Chicago exchanges trading grain futures, it reported, it still reports, to the Senate Agriculture Committee. And I'm going to come back to that little fact later on. Chicago is a world of leverage, as traders put it. That's to say, with a small deposit, a small margin payment, as it's called, you can trade financial instruments worth a great deal of money. You can get higher leverage than you can directly trading shares. So if you, as a trader, feel that you have some information relevant to the value of US shares as a whole, it's to the Chicago futures market, to futures contracts, and above all, the futures contract on the S&P 500 index. It's to that you will turn first, because you can lever more in the world of futures than you can in the world of shares. So this means that new information relevant to the value of US shares as a whole appears first in Chicago, in the futures market, and then a fraction of a second later in the stock market, originally in New York, now in those data centers in New Jersey. To begin with, futures were actually traded in Chicago's traditional pits, and there was a huge struggle about the move to electronic trading in Chicago. My picture there is at the intermediate stage. People in the pit, in the yellow jackets, people sitting in a kind of tower up above them. I'm afraid the photograph doesn't actually do justice to the configuration here, trading electronically. But gradually, the yellow jackets disappeared. In fact, this year they have finally disappeared completely. And gradually, indeed, the men and women typing have been replaced by computer algorithms. So when I asked Automated Trading Desk, as I said, the first high-frequency trading firm in the world, most likely, what was the structure that made it possible for their algorithms to predict price movements? They said the key thing was futures lag. This effect that the underlying shares move just a fraction of a second later than the futures. It still exists because the two worlds, futures in Chicago, shares in New Jersey, have separate regulators. The Commodity Futures Trading Commission, reporting to the Senate Agriculture Committee, and the Securities and Exchange Commission, reporting to the Senate Banking Committee. It sounds trivial, but this means two separate power bases in Washington. And all attempts, for example, by the financial reformer Barney Frank, all attempts to end the separation have failed. So the institutional support, the congealed outcome of the struggle, still exists. But of course, it's a material thing as well as a political, social thing, because there's no point in knowing that futures move a fraction of a second in Chicago before shares move in New Jersey, unless you can get that bit of information from Chicago to New Jersey. And there's a whole technological history here. The signals originally traveled down fiber optic cables, but fiber optic cables don't follow the geodesic as they were originally laid, because if you're laying fiber optic cables, why do you think that a couple of milliseconds, 2,000th of a second, matter? In 2010, a new, more direct cable was opened, and its owners were able to charge huge sums to high-frequency traders to be able to use that new, more direct cable. But of course, in optical fiber, light is slowed down by the refractive index of the material, which is approximately 1.5, which means that light in an optical fiber travels at around 2/3 of the speed of light in a vacuum, and 2/3 of the speed of light is not fast enough if some other algorithm can be faster. So hence the move to transmission through the atmosphere, hence the need for the New York Stock Exchange in Mahwah, New Jersey, to have this giant microwave tower, partly to communicate with the three other data centers trading shares, but also to communicate with Chicago. So the geodesic from Chicago to New Jersey is getting kind of crowded. Everybody wants to place their microwave dishes along that geodesic. So that what you do, because you have to worry about interference between different microwave dishes, so that drives you from 6 gigahertz, where you're pretty safe from interference from the weather, up to 11, 18, maybe even as high as 23 gigahertz. And then rain starts to interfere with the signal. And I'm told that you can see the traces in the price movements in New Jersey of rain in Pennsylvania. Even something as benign as the summer sunrise and sunset over the Great Lakes can disrupt things. Because under those circumstances, the upper atmosphere is warmed more than the lower atmosphere, and that affects the ratio of the refractive indices of the two parts of the atmosphere. So that too can disrupt the link. So that's the story that I've told you. Thank you very much.